The lower your down payment, the better. What's up, you guys? Welcome back to WideBody Nation. Tons of you have been asking me, what should you put down for your lease, for your finance, for your new car, used car deal? Well, in this video, we're going to go over pretty much anything and everything to do with down payments and why you should seriously consider putting a smaller amount of money down because, well, this thing called opportunity cost. So in this video, we're going to go over why I think you should not put a bunch of money down, what you can do to protect yourself since you're not putting a lot of money down, and three, some of the issues you might run into when you're trying to, go do a $0 down or a low money down deal that the bank or the dealership or whoever it may be may have an issue with you. So this will really be everything you need to know about down payments. So with that being said, quick reminder, we have M1 Finance that is still doing their $30 promotion for you guys to sign up and start trading stocks on M1 Finance. They also offer some other banking services, very helpful, and I enjoy their pies. And then Webull is doing the 4 free stocks when you deposit your first $100 to start trading. Far superior to Robinhood. Change my mind in the comments below. Speaking of the comments, I would like to hear what your down payment philosophy is. So jump in the comments. Tell me if you're, if you're like a $5,000 type of person where it's like, hey, $5,000, boom, 10 grand, whatever it is, or zero down, whatever. Or if you're more like a 10% down or a 20% down type of person, what is your philosophy on down payments? All right. So first of all, the biggest term we need to introduce in this video is the opportunity cost. And that is, simply put, an opportunity cost is basically the option you have with your money, right? So if you have $5,000 that you're looking to put down on your vehicle, what else could you do with that money? Could you go buy $5,000 worth of GameStop stock and that turn into $1 million? Obviously a joke, right? But could you go invest that money or put that money to work or pay off other debts, maybe high interest credit card debt, that would actually net you a better return than, just saving some interest on your down payment? So we're not just going to talk about, wishy-washy numbers here. We're going to get into the nitty-gritty, right? So here is our example car. We have our 2021 Dodge Charger SCAT Pack Widebody. After the manufacturer incentive power dollars, we are down to about $50,000, 49, basically $50,000, right? So we have our handy dandy monthly payment calculator, and this is where the interest paid really comes into play, folks, all right? So you guys, most of you have seen this, but if you haven't, it's at realwidebodynation.com. You can actually go in and enter your information to use this, but we're going to be using this in this video in Microsoft Excel. Now, like I said, opportunity cost. Let's just say you guys were going to be doing just a relatively small $5,000 down payment, right? So boom, $5,000 is the money you have in theory to potentially either put down on a car payment for a lease or finance deal, right? But what is the other opportunity? So let's toss it in right here. In my opinion, the baseline generic rate of return that you could get is 7% or more, but we're going to do 7%, which is adjusted for inflation, because you can invest in any of these Vanguard or other companies' index funds that will get you between a 7 and a 10% year over year return. This index fund, which I have several $1,000s invested in, the Vanguard Total Stock Market Index Fund, the VT-SAX is the ticker, let's see, where is their returns? Okay, we're going to jump down here, and the performance, we can jump in right here. Their average rate of return is almost 11%. So we'll put 10% just to be conservative here, right? We'll put 10%, and let's say you're financing your car for 6 years, right? We're going to go ahead and compute. So this is saying that after 6 years, 72 months, your $5,000 is going to be worth $9,100. So you're going to make $4,100 worth of like interest or capital gains on that investment. Whereas if you were financing your Charger and you put that $5,000 down, let's jump into the calculator here, folks. So we've got our 53 grand Charger here. Boom. Gonna get rid of the dealer discount. Boom, boom, boom. We do have tax tags and title in here, and I will add the 5 grand down payment. So we are looking at, let's just say we're doing 4%. We'll highlight and underline that right here. Look at the interest paid here, folks. Look at the interest paid and look at the monthly payment. Now this is with our down payment in. We're looking at $767 down payment, so I'll put that over here. $767, and we're looking at $5,144 paid in interest over the life of the loan. That's the entire life of the loan, just like you would have put that $5,000 in for the entire life of the loan, 6 years, 72 months, right? Let's simply take this down payment out and let's check out what the change is. How much did the down payment save you? Let's see. So the down payment looks like interest paid is now $566.9, so $5,669, and the new monthly payment is $845. Let's just make sure I copied the right cell. Yep. Okay, we're good to go. $845. $845. So your monthly payment went up by about $80, we'll say, so that's a difference of $80. And then the interest that you saved over the life of the loan, that's only about $550. That is not very compelling to me personally. You're saving $550 in interest, whereas you could go be making over $4,000 over in the stock market in a very conservative fund. That opportunity cost is key. And 10% is relatively conservative right now because that's what this, you can literally go to Vanguard right now, open an account for free and get into this index fund and be exposed to this growth right here. Look at this, 5-year growth. It went from $46 and now it's up to about $96, $98. Yeah, it's got some dips, but if you're in it for 5, 6, 7, 10 years, you're going to see that growth, in my opinion. Obviously, we're looking backwards, not forwards, hindsight being 2020. Now, a lot of you naysayers might be in the comments. You might be saying, hey, WideBody Nation, I get it. Putting the money somewhere else with hypothetical good returns, everybody can Monday morning quarterback this, right? Obviously, everyone should invest in Tesla a year ago, 2 years ago, should invest in Netflix back when it came out, all that good stuff, right? Now we're moving on to number 2. Protecting yourself when you do a 0 or low monthly payment, and actually why it is better than making a down payment. So a lot of you guys have probably watched my gap insurance video that is guaranteed asset protection. Now, when they say asset, that's, you can argue whether or not a car is an asset. If it's putting money in your pocket, then it is an asset. If it's taking money out of your pocket, it's not an asset. But anyway, that's not what the video is about. Gap insurance, anywhere from $100, $200, all the way up to $1,000, is a very simple way to protect yourself against that oh crap moment when some random yahoo T-bones your brand new WideBody SCAT pack that may or may not be worth as much as you owe on it. Because as you guys know, this tax portion, that's really where people get the idea about, cars lose 10% when you drive them off the lot, 20% when they drop. It's because you're paying all these taxes, fees, registration, all that stuff. That's your 10% right there. But I digress. I'll do a whole video on that. When you add the gap insurance, so let's say you add, gap insurance for $599. That gap insurance is protecting you because you're going to owe about 55 grand. And let's say your SCAT pack that was a sticker price of 53, let's say that's only worth, according to the haters, 45 grand. Now, do you want to be on the hook for that 10 grand difference? Like you personally, you watching this video right now, do you want to be on the hook for that? Or do you want your bank or the insurance company to be on the hook for it? Because if you put a big down payment down, let's say you put 10, 15 grand down. Let's say you put 15 grand down. Now you only owe 40 grand on the car, but that doesn't change the fact that the bank and the insurance, the insurance company, when they're paying out your total loss, is only valuing your car at 45 grand. Yeah, you'll get a 5 grand difference in the check, but you already shelled out 15 grand, my guy or my girl, or whatever you may be. So, in my mind, as long as you've got a good interest rate, just get GAP for the couple hundred or $1,000, in my opinion. Let the bank, let the insurance company figure it out. Hey, I got GAP insurance. Like, my insurance company, I don't even care what you value this thing at. As soon as you come at me with a value, whether it's fake news or whether it's actually fair, I'm turning right around to GAP insurance and say, hey, you got me covered. You covered me up to 150% or whatever the terms are. Again, watch the GAP insurance video to make sure you guys are well schooled up on that. But that's why I do not do big down payments. Sometimes I'll put $1 grand, $3 grand, $5 grand down to cover the warranty products, cover the taxes and fees or whatever. But like, let the banks, let the insurance companies take the hit when some random person comes and crashes your car, because I don't want you guys to take the hit. Your down payment, if it's big, is you shelling out that money. So, moving on to part number 3 of the video. Now, the first 2 parts of the video were basically under the assumption on my part that you have good or decent or great credit, because a lot of times, folks, in order to get into these higher value cars, 50, 60, 70 grand cars, not insurance, but these lenders, one of the ways they can get people with only okay credit into them is if they shrink the loan down a little bit. So if you want to get into a $53,000 car, they might say, hey, we need a 20 grand down payment because we only want to loan you 30 grand or 35 grand here when you take into account taxes, fees, GAP insurance, I guess we can take GAP out of here because technically you wouldn't need that. So, you're still loaning them 34 grand, but that's better than 54 or 55 grand, right? So, yes, the first 2 parts of this video were under the assumption that you have good or great credit. However, if you have the opportunity to do a lower or no down payment, in my opinion, it's a very easy choice. That money can be used to pay off credit card debt, put a down payment on a house so you don't need mortgage insurance, or even just straight up get a house instead of renting if that's what you're interested in. I'm a pretty big fan of renting when it makes sense, but also buying a house when it makes sense. It just depends on your situation and whatever it may be, right? So just to sum it all up, right? Obviously, credit score is a major factor. Obviously, there's other factors that are in play, but if you have the option to do a lower down payment, I would certainly do that on a car. On a house, totally different story, right? But just think about it this way. Would you rather the bank have your 5 grand, have your 10 grand, have your 15 grand? Or would you rather have it? Because if you get hot under the collar, if you're like, ooh, this car payment is rough, I don't know if I want to pay this for 4, 5, 7, 8 years, whatever it is, you can always take that money and put it towards the car. You have that option. Basically, you are retaining the freedom of choice, the freedom of whatever you want to do when you do not make that massive down payment. Because once that money's gone, it's gone, right? Let me know what you guys think of this video. Don't forget to subscribe. We are doing our 5,000 subscriber giveaway for these Apple AirPods Pro. If you're watching this far in the video and you haven't subscribed, I am surprised. But over 80% of people, YouTube tells me, are not interested in winning these AirPods Pro. It's kind of weird, but whatever. Check out Webull. Check out M1 Finance. That's over $50 of free value when you sign up for both of those. I use them on my phone every day, especially with all this GameStop stock and AMC Robinhood fiasco. I'm transferring my stuff out of Robinhood because I don't want anything to do with Robinhood anymore. But appreciate you guys tuning in again. Let me know what you think about the whole down payment concept for cars, for houses, whatever it may be. I appreciate you tuning in. Stay safe out there, and I will see you for the next video.